Meantime, let's get right to our first big interview of the hour. The new op-ed from our next guest in the Wall Street Journal is titled, "What the Stock Market Taught Us This Year. Don't Fall for These Investing Traps." Joining us right now in a Squawk Box exclusive, Mellody Hobson is here, co-CEO and president at Ariel Investments, and John Rogers, co-CEO and chief investment officer at Ariel. And we were just discussing, I don't think we've ever had you both together.
Ever.
Over all these years.
Exciting.
We've had you independently, but never together. Anyway, it's very nice to see you. John, it's nice to see you, too. You're sitting across from me, so I'm just going to ask you. The lesson, if there is any lesson in 23 to take away from 24, it is what?
If there's any lesson in 23 to take away to 24 is what worked in 23 is not likely to work in 24 because the pendulum swung so far one way specifically as it relates to the Magnificent Seven. Those returns are stunning. The weighting in the S&P 500, stunning. It makes the Nifty 50 look like child's play, with those 7 stocks being 30% of the benchmark, and now over 100% of the return, which is hard to even think about because of the negative returns of some names. And the idea that those 7 stocks are 3 times the market cap of the Russell 2000, which is where we fish, as you know, at Ariel. So those 7 stocks are 6,000 small cap stocks. That to us means things have to start moving the other way. And yesterday was interesting. First time all the benchmarks were up and the Magnificent Seven were down since 2012. Maybe the beginning of this change that we see.
So, John, the question is, if that's the case, are you supposed to, A, buy small caps, and are you supposed to short the big caps?
Well, I'm not a big believer in shorting. That's really, really difficult to do. And so I'll let my friend Jim Shanos be the expert in shorting. But we do think it's an extraordinary time for smaller stocks and value stocks. It is an unprecedented time. It reminds us so much of the internet bubble. And when that burst, as we know, it was a great time for small value as the growth stocks collapsed.
So when you say burst, does that mean you think it burst something even worse than where we are? I mean, not to say where we are. It's actually been on a nice little run here. But you think that the market is coming down even further?
You could underperform. The Magnificent Seven could underperform, and the other stocks that have just been overlooked could do much better without
the
this.
Averages may not necessarily move around as much. You're just
correct, because
pockets of strength.
Exactly. We feel like those stocks have so overwhelmed the index in terms of the return. You have all of this underperformance underneath, which people really aren't quite understanding, which creates so much opportunity for the future. And we're not saying these are bad companies that are just going to, fall over. You can be a great company and not a great investment. And I think that's where we think we are right now.
Okay, but so I'm going to go to John for a second. In the sort of Warren Buffett camp of just buy the S&P and close your eyes for as long as humanly possible, does that make sense in this environment given the overweighting, frankly, of these 7?
Well, it's interesting. Warren is my hero and someone I think is the most extraordinary investor of all time. But I do think every once in a while things get way, way out of kilter. And I think because the index is so populated or it's being influenced so heavily by these large 7 companies, it's not a time to just buy the index and go to sleep. I think if you're over the next several years, I think it's going to be a greater time for the stocks that are misunderstood, neglected, not well followed, not well researched on Wall Street. Everyone's forgotten about them. A lot of hidden gems out there that are extraordinarily cheap. I think that's where the opportunity will be.